Hi, everyone. Welcome to another episode of Bits and Bips, the interview. I'm your host, Steve Ehrlich, and we've got a lot to talk about today. But first, I'd like to introduce my guest, John Todaro from Needham and Company. He is their point man on all things crypto equities. And in particular, he has a unique expertise in mining, and we're going to get into all of it. So, John, welcome.
Thanks for having me on. Good to be back.
Yeah. You are a repeat guest, and I'm really interested to kind of see how the conversation is going to be different than it was a few months ago when all of the Bitcoin miners were kind of re-rating it as part of this whole AI HBC buzz, whose, I guess, luster has worn off a little bit. But before we get to all of that, just a quick disclaimer: nothing that you guys see or hear today is financial or investment advice. For more disclosures, please see unchained.com/bits and bips. And with that, one more thing before we really get started, we need to take a very quick break so we can hear from some of the sponsors who make this show possible.
This episode is brought to you by Adaptive Security, the first cybersecurity company backed by OpenAI. As AI makes deep fakes and synthetic identities easier than ever, Adaptive helps companies test and strengthen their defenses. Learn more at adaptivesecurity.com.
If crypto taxes feel overwhelming, you are not alone. That's why Crypto Tax Girl, a team that's been helping crypto investors since 2017, is offering $100 off on one-on-one crypto tax help. To get $100 off your crypto tax services, go to cryptotaxgirl.com/unchained. Again, that's cryptotaxgirl.com/unchained.
Okay, so let's kind of get started. John, when you were on the show a few months ago or late last year, the whole conversation centered around the ways that analysts were completely rethinking how they were approaching Bitcoin miners because of their power generation capacity, their hosting capacity, and sort of the insatiable demand from AGI providers to sort of get as much capacity as possible. And in many ways, this was a really welcome sight because Bitcoin miners, I've always had a bit of a soft spot for them because they're kind of the unsung workhorses of this entire ecosystem. Yet their stocks always drag the price of Bitcoin. They drag DATs. Demand was siphoned away from them for ETFs. And they were always sort of, none of this works without miners, but their stocks were always trailing the sort of like the base assets. That completely changed, and we spoke about that. But today, things are different. Bitcoin is struggling. It's below 70,000. It dropped as low as 60,000 last week. That's creating some real dangerous economics for miners, and I want to get into all of that. And sort of the shine has come off of the AI boom. We've seen huge tech sell-offs, especially in the last week or two. So I just want to start off by kind of asking, what are you seeing right now? And in how this environment is really impacting Bitcoin miners.
Yes, so the Bitcoin miners are still very much going down the AI route, so providing data center capacity for AI workloads. That hasn't changed at all from our last conversation. If anything, they've gone more into that with the Bitcoin weakness. I think it's kind of, because you're also seeing hash price continue to go lower too. So I think that's confirmed for a lot of these Bitcoin miners that the path they have chosen maybe 6 months or so ago is the path they ultimately want to be on. They want to be on the path for AI workloads. Now, there are some specific impacts to kind of data center operators for AI right now, which is weighing on the stocks a little bit. And then there's also just a broader tech sell-off that is kind of impacting names to an extent too. But I would say that they're very much going down that route of doing supporting HPC AI workloads. We've gotten a few new leases in late last year. So in December, Hut signed actually the best contract we have seen so far. So that kind of reaffirms to us that the demand is still very strong, and if anything, has gotten better in the terms of actually improved for these Bitcoin miners since earlier last year. Around the summer when a lot of these deals got signed. So from that standpoint, the terms have improved. The demand seems still very strong. You've seen those new CapEx guidance numbers from all the major hyperscalers. A lot of that's going towards AI, right? And so that actually beat expectations by quite a bit.
Yeah, and that
So there
scared
is still very
markets.
much demand for that. What's that?
I think I saw the number. It was like $660 billion or something, and that
Across them,
and that spooked markets. I mean, that scared everyone last week. But what you're saying is that that's going to ultimately benefit the miners, like the capacity providers in some shape or form.
Yeah, I mean, the spook is more so, are they spending too much on AI and could potentially put some of these companies in peril? From a Bitcoin miner standpoint, you want the major hyperscalers to continue to spend money on data center build out, sign leases, put more towards CapEx. So I think from that standpoint, it's a positive signal for my miners that, hey, companies aren't pulling back from spending on AI, they're doubling down. I think the market is viewing it a little bit longer term and going, okay, how much CapEx are we going to ultimately spend on this? What is the refresh cycle going to look like? And that's where things get a little bit more concerning. Why I also like my miners is they're doing a colo lease for the most part, so they don't have this aggressive CapEx treadmill like you see when you're buying the GPUs and that infrastructure. That starts to look a little bit like a Bitcoin mining CapEx refresh cycle, which I didn't love, which is probably one of the reasons why Bitcoin miners kind of always trailed Bitcoin and some of those other assets you had mentioned earlier. So a lot of them are doing colo leases, so you're not on the same kind of aggressive CapEx cycle. There's still a ton of CapEx to build these data centers, but you at least don't have that very real and significant depreciation on the GPUs. So I'm not worried about the CapEx numbers. If anything, I kind of take that as a positive for my miners. There's still a lot of demand for what they're offering.
Okay, just a couple of follow-up questions to what you just kind of walked us through. One, you said Hut 8 signed a very, I guess, what's the word you used? A very lucrative,
very attractive.
Very
yeah, one of the
attractive.
best deals.
What does that mean specifically?
Yes. So they got the full credit backstop from Google. So that allows you to build at you can get financing a little bit easier, so lower rates on your debt that you need to layer in and actually build the data center. So that was attractive. So that arrangement was done in it's with FluidStack directly, and then Google is the credit backstopper. That was the first agreement we saw where Google extended credit over the entire length of the lease, which if I recall, it's 15 years. So the other ones you saw, it was maybe 5-6 years. So it's over the full length of the lease. The economics in terms of kind of top line, the revenue per megawatt was a bit more attractive, a little bit in line with some of the other leases. I would say higher than kind of your average one you saw when there is a major hyperscaler backstopping versus the ones over the summer. So I think that one came out to about 1.51 million per megawatt. In first year numbers, there's 3% escalators. So the revenue you receive every year goes up about 3%, but it starts at a little over 1.5 million per megawatt. And then they also have longer to execute. So I believe they have 14 or 15 months for the RFS date, the ready for service date, on that contract. And so that's a big piece now we're seeing too, where if you're delayed and you have execution misses, you normally discounted rent that happens within that. So we do like that you're getting more time to execute, so you're not up against a very aggressive date where you have to deliver the data center. And also, a lot of these contracts become cancelable after 90 or 180 days past that date I talked about. So if you're delayed 90 to 180 days,
that's the RFS date.
Yeah, that service date for the data center, the contracts become cancelable. With Hut, that's not the case. They don't become cancelable.
Okay.
There's still going to be discounted rent, likely. I'm sure there's some discounted rent. But we do think they have a little bit more wiggle room on execution too. So what that indicates to us is hyperscalers are being a little bit more lenient with these counterparties, with the Bitcoin miners. They're also looking to or willing to extend full credit over the entire length of the lease and make it easier to finance. So that all indicates kind of better terms, that the miners have a little bit more negotiating power. They're not up against a super tight window and they're not getting credit backstopping. They are getting those now.
So do you see these Bitcoin miners as a bit of a more value play if such a thing exists within the tech sector, because of the fact that they're getting these attractive terms and and sort of there's more of a bullish case to be made despite this sort of dreary feeling in markets at this point?
I would argue yes. So most of these names we are buy rated on, and we have we got price targets higher than where current price is. It's a few different ways how you want to value it and look at these stocks, though, right? If you comp them to the large traditional data center REITs like Equinix or Digital Realty, these are trading at a discount. I think if you're able to execute on some of these contracts, I think you start to close that discount gap very quickly. And you also need to kind of continuously show that you can get access to more power. If you're just kind of one and done, then it's going to be very hard to go slap a data center REIT multiple on these businesses. But if you can show you're able to continuously get power, they're signing better contracts than Equinix and Digital Realty get. They're building bigger, more complicated data centers than those names are building, the traditional data center REITs. In the HUT example, that lease was a triple net lease, so very good margin. So I would say, if you're able to kind of consistently do this, you should close the gap and maybe even trade at a premium to the data center REIT. So from that standpoint, maybe they start to look value relative to those names. I think where the market has more concern is, are you going to be able to continuously get power, or are you going to be one and done? Because if you are one and done, how you should value these names, you shouldn't apply a data center REIT multiple to them. You should more so just value the cash flows from the contracts they have signed. And when you do that, we've done that math, it does equate to about 40%, maybe 50% lower in the equity value than where the stock's trading today. So, you do need to show that you can continuously get power. And that is a big question in the market right now. And then two, you need to show that you can execute. Because if all these guys start falling down and aren't able to execute, maybe leases start getting canceled, and you really should trade at a significant discount to the data center REITs that can execute.
Understood.
So those are the two pieces that need to be, that need to give the market comfort right now.
Understood. I have one more question about all of this, and then we're going to actually turn a little more back to Bitcoin mining. But you talked about how sometimes the CapEx is cheaper. It's easier than procuring Bitcoin miners by themselves. I mean, we both remember going back to even like the heady days of 2021, the pandemic, when miners were paying 9 months, sometimes a year in advance for machines that weren't even built yet in order to kind of get first in line, because there was never going to be enough capacity from the Bitmains and MicroBTs of the world to satisfy all demand. And I mean, the outlays were 9 figures, sometimes 10 figures to get these devices. How is it different when it comes to acquiring GPUs and sort of like building out the infrastructure inside these hosting centers?
It's not all that different. The argument I was making is these Bitcoin miners aren't responsible for the GPU CapEx. So that's where they're tenants in most of these. It's called a co-location lease, where the tenant brings in their own GPUs. So for most of these, Iron's different because Iron is going down more a cloud compute route. So they have that contract with Microsoft where Iron is spending CapEx on the GPU. So it does look a little bit more similar to that Bitcoin mining kind of CapEx you were talking about. The other names, for the most part, are doing colo leases where they're not responsible for the GPU CapEx.
Okay, so like a Marathon, for instance. I mean, they would have to get the capacity, or some sort of vertically integrated miner. They would have to get the capacity, the power, everything, and then they would have to procure the ASICs. In this case, the companies themselves are doing steps one and two, but when it comes down to the GPUs, the actual engines, it's like Google or FluidStack or whoever is the client is supplying it on their behalf.
Exactly.
Got it. Okay.
Exactly.
All right. And I'm sure that's, I mean, that's easier from a cash flow point of view for some of these companies. So, all right, let's turn directly back towards Bitcoin mining, because you pointed out how hash price is down. I mean, it's been continuously going down for years at this point, but this is a very precarious point for Bitcoin miners. I know the answer to this question is it depends, because every miner has a different sort of cost of production, but it seems like the 60,000 range is dangerous for almost everyone, even though everyone's talking about strategy more. Their danger point is like 8,000. So, I mean, what do you see right now? I mean, hash price is continuing to go down. If Bitcoin does not break out of this range to the upside, are you seeing a lot of stress on the finances of these miners? Is it going to mean that they keep turning even more, I guess you even said, more towards AI and not buying more miners themselves? Are they going to have to start selling Bitcoin to cover expenses? What are you seeing there?
Yeah, I would say so. It is more topical now than it's really been kind of around this cycle, right? So we were just on an earnings call today, and it was one of the I think the first time kind of this cycle where we heard, hey, are you going to turn off rigs given where Bitcoin prices are and where hash price is? So it is starting to become a much more topical question, which we didn't really have before. There was definitely some margin in there. At these levels, you're pretty close to cash break-even costs. In some cases, some miners might be higher on cash production. When you factor in the depreciation on the GPUs, a lot of them are above where the Bitcoin prices are, or kind of right around it. So from that standpoint, yes, it starts to be a little bit more of a concern than obviously it's at when Bitcoin was 85K and hash price was a little bit higher. What I would say though, in terms of the Bitcoin miners pivoting to AI, I don't know if any of the names in my coverage universe are looking at it going, okay, Bitcoin is here, I'm going to push more into AI, because the AI component was already just so much better from a stock perspective. You're talking about 15 times on an EV EBITDA basis is maybe what the markets is paying for an AI data center. A Bitcoin miner, they're going to pay like 4 times EBITDA. So you already had a massive difference in the multiple, and then the underlying kind of the dollars per megawatt you could generate, and the stability of that too, because these are stable 15-year contracts, right? So the margin. That profile also looked a lot better for AI versus Bitcoin mining. And then you look at just the ultimate AI demand. I mean, one of the reasons a lot of software stocks have been weak is AI. AI is going to eat software and all that. So it is kind of AI is reshaping a lot of the economy, financial markets. So that demand also is just significantly stronger too. So it's, I would say none of the miners are necessarily going, oh man, Bitcoin's now down 25% versus this, we're going to pivot a little bit more towards it. I think it was more so of a light bulb moment of, if you can go into AI workloads and felt comfortable in your execution, and if your sites were set up for it, you're going to go down that path. I don't think Bitcoin being a little bit lower here really changes that. I think they made up their mind that the train has left the station. Most of these miners are going down AI workloads, and you would need something on the AI side to break for them to pivot back to mining.
Understood. Okay. So let's talk a little more then about hash rate. I mean, it's pretty much been going down since I guess October. I mean, October 10th, middle of October, when Bitcoin hit an all-time high of, I think it was 126,000, and it's been a continuous trend downward since then. You mentioned how I guess one of the companies you were on a call with today talked about perhaps reaching that point where they start turning off machines because it's no longer economic to mine. But where has the drawdown been coming from so far over these last few months?
Yeah, and in fairness, this company said on the call, we haven't reached that level yet. So, okay. But it is becoming topical. There's another sell side analyst who asked that question. So it is popping up. It's just on prior analyst calls, I don't think I've heard that. So that was one of the first times we're now starting to hear it again, and it makes sense. I mean, the prices where Bitcoin's at, that's it makes sense to ask that question.
Yeah, of course.
So in terms of kind of why hash is maybe coming off the network, I would say it's a combination. You're likely have high cost miners exiting, right? Older rigs being taken offline that are no longer profitable. We are seeing that. So a lot of these companies do want to continue to kind of refresh. Some of them have more access to rigs, and so you're able to slate in more efficient rigs versus older rigs, and so you're taking older rigs off. And then you're starting to see a real effect from, at least in the US, your public US Bitcoin miners moving data centers towards HPC AI, and that's resulting in some hash coming offline. I would say still a lot of these companies like CleanSpark, for instance, they're going to be doing Bitcoin mining at one of their sites up until the AI data center is ready to go, and then they're going to be able to kind of switch, kind of fairly close to that the date for when the AI kicks in. Some of these other ones need to start making the allocation now, where they're taking some of those data centers down that are for Bitcoin mining and putting in HPC AI. So you've seen some of that. The point I'm trying to make is you're going to see more of it. So if you look at the Bitcoin miners in the US today, the public ones, they still have a lot of data centers dedicated towards Bitcoin mining, but those are earmarked for AI, and the work on kind of retrofitting those towards AI is happening. And at some point, when those contracts start kicking in for AI, there won't be Bitcoin mining at those sites. They will if they take that down. So that's also another chunk of hash that will likely come off the network. You're seeing some of that today, but keep in mind, most of these AI data centers have not been built yet.
Okay. So that's actually really interesting. So is it, we're talking like 1 to 2 years in the future? I mean, give me a timeline. And also, what do you think hash rate is going to settle at once we reach that point? Because perhaps it's time to, perhaps some people listening here today might think, well, I can try to calculate what hash price should be once we reach that point where the competitive environment for mining is a little less arduous.
Yes, the timeline about that, like a 12-month time frame, you're going to see more of the public miner hash go down for some of these companies. Now, other ones are growing it a little bit, so it's not kind of everything will happen in tandem. But I would say on average, the public US hash, the percentage of the hash, and also just absolute hash, should come down, and that's likely going to happen over the next 12 months. As these data centers get built out. And then it's going to accelerate on probably a 24-month time frame. If I'm looking at who's trying to secure AI leases now, and when those data centers ultimately get built, you're kind of on a 12 to 24-month time frame. And so more hash will come off the network over that frame. In terms of the kind of net impact, it's hard to tell, right? Because then there's more efficient machines. Some are growing hash a little bit. Will they be able to find a little bit more power and then put Bitcoin mining back to those sites, right? So there is also a conversation among some of these Bitcoin miners is, hey, maybe I have a big site that I want to do AI with, and it's suitable for AI, but maybe I can still go procure in that 24-month time frame some more remote site or a site that maybe isn't suitable for AI data center workloads. And I can go put my rigs over there and do Bitcoin mining there. So if they don't find any extra capacity, I don't know, it'd be a decent chunk, maybe 5, but also not everything, right? I mean, keep in mind the miners are, I think maybe only 20% of the total network. It's not like they're 50.
Yeah, I mean that's the important point. Like publicly traded Bitcoin miners is not the entire Bitcoin hash rate. I mean,
right.
Most people listening here probably know that, but it's always worth kind of reiterating.
Yeah. So I would say probably if you just take all their hash they have today, I would say probably about 25% of that comes offline over the next like 2-ish year time frame.
Okay, that is interesting, and probably a bit of a welcome respite for the ones that are still committed to doing it.
Yeah.
I had one more question along these lines, but I'm actually blank. Yeah, here it is. Last time that there was a big bear market, we were actively tracking how much Bitcoin was being sold by miners. And that became a big hurdle that needed to be overcome in order for the price to sort of go back up. And obviously all that changed in the middle of 2024 when Donald Trump embraced Bitcoin and away we went. Are you tracking right now Bitcoin miners? Have any been selling in mass? And are conversations happening about having to liquidate some funds in order to cover expenses?
So they have been selling, but not necessarily to cover expenses. The ones going down AI routes, if you're signing a hyperscaler agreement, so like a Google, Amazon, you're able to get financing. Cypher just closed that very attractive financing, right? It was very low rate. They were able to get on that. So no one's really, if you're going down the AI route, needing to necessarily sell Bitcoin to fund operations. You do have, at least the public ones, they have access to the capital markets, and the capital markets are willing to lend to them if they have these contracts in hand.
I guess I'm sorry. I was going to ask too, like aside from that, just like operational expenses, overhead for operating the mining part of the business.
Yeah, so some of them, yes, but that's been their policy for a while, right? Like Cypher, I think, sells a good chunk of their Bitcoin always to just kind of support their operating business for their cash costs on running that business. And they've done that for a while. So it's not necessarily kind of a change with where Bitcoin prices are. The ones we have seen sell more Bitcoin than they otherwise would have has been more so related to AI. And you started to see them selling a bit more even before Bitcoin really broke down and started to sell off. So, I guess the overarching point I'm trying to make on this is, yes, they are selling down Bitcoin, but more so to one, signal to the market, hey, we're really going down AI. We're taking it seriously. We don't want to be as closely correlated to Bitcoin. We want to decouple a bit from Bitcoin and the price of Bitcoin. And we also want to take those proceeds and maybe invest them into AI, versus any miner going, hey, we're strapped for cash. We're at very negative margins here. We need to sell Bitcoin to fund our operations. I haven't really seen that, at least among the public ones I cover. Private companies, likely different. You might start seeing that, but not among my public names.
And I guess one last question to just kind of distill the main question that I think some of our listeners might have is there some sort of big sell wall coming if the price of Bitcoin drops into the low 60s or below for a sustained period of time? Everyone's wondering, like, when are we going to reach the bottom? What does capitulation mean? Do you think we're sitting at, is there a danger zone that people should be paying attention to?
I don't know if there's necessarily a hard sell the miners would have to do, but I've always considered it somewhat of a danger zone when you're at your break-even costs. And to your point earlier, we're at that for a lot of these public Bitcoin miners, or you're likely a little bit higher than that. But if you get, into the 50s, low 60s, you're putting that margin a little bit more under pressure. And then you have to think about the next halving's coming up. That's starting to loom, right? So then that's another thing these guys have to start considering. So that's I've always viewed that a little bit as a danger zone. But I wouldn't say, there's not necessarily kind of a hard point where they need to sell. And it was different from last cycle, because last cycle they did take on a lot of debt to fund the CapEx cycle for Bitcoin mining machines. Many of those companies went bankrupt, and what emerged, you didn't have Bitcoin miners taking on debt for their Bitcoin mining initiative. So a lot of them, if they're doing pure play Bitcoin mining, you don't have kind of certain debt that you need to pay down or anything like that, big payments that are coming due. You are starting to get a lot of debt, but it's all linked to AI. They're not being lent these funds for Bitcoin mining. They're being lent this for their data center builds. And so they are layering in debt, but it's specific to AI data centers. In some cases, they're kind of borrowing at that data center level versus at the corporate level.
Gotcha. Okay. Thanks for all that. Before we just touch on a couple of other small topics before I let you go, is there anything else related to the AI Bitcoin mining conversation that you'd like to mention?
Yeah, I think what folks need to be considering too right now is, if all these miners are going to be able to get power, right? And that's been a question. It's been a question since they all started to pivot. But you are seeing a bit more pushback from a political standpoint at the state level around, hey, should we really be granting all this power to data centers and to build all these data centers throughout our states and maybe localizations? You're seeing protests in some cases. So I do think that isn't fully fleshed out yet. If there's going to be more political blowback and there starts being kind of less power that these miners are able to get than in what everyone has in their pipeline. And the market's trying to sniff that out a little bit right now too. The big thing to look for right now is the ERCOT, their new batch processing. It's not yet decided. It's unclear kind of where that ultimately shakes out or what those rules will be. If the miners all get the power they expect, many of them have said, yes, we do fully expect us to get the power that we're kind of in. Some have framed it as grandfathered in. The reality is I just don't think we know yet, but we are starting to see a little bit of pushback from kind of at the state level around all this power and compute going to AI workloads.
Okay, got it. All right. Well, thank you for walking us through all that. Just a couple of other crypto-related topics to discuss. Coinbase is reporting earnings later today, I guess after market close. Expectations are, like every other company that's already reported, a disappointing quarter. But what are you looking for, and what do you want to hear from Brian Armstrong and the rest of the leadership on the analyst call?
Yeah. So in terms of results, I think our estimates are a little bit lower than street consensus. So if you take that view, you would say, okay, there's going to be kind of a narrow miss. But I would say the buy side has already kind of brought numbers down. I think what's also going to be a bigger deal, because Q4 should be okay. And we have Robinhood out there. Q4 was okay. What is going to be the bigger focus is what's happening right now in Q1 and also the outlook there. What Brian Armstrong, so first off, what we're going to be focused on is retail take rates, because retail is such a big part of that business. It's one of the items we don't know kind of where take rate ultimately landed. And then the actual share of retail volumes, you don't know those actual numbers yet. You can have a pretty good estimate, but you don't know those actual numbers until earnings.
And
so
the take
we'll look
rates
for
have
that.
been really sticky for Coinbase for years, despite some people.
They've been fairly sticky. Yeah. But a good chunk of that will be mix shift. So I would expect it to come down some, which typically happens in these type of environments. But you saw that a little bit with Robinhood as well. But the bigger question is going to be kind of, where does the crypto industry evolve from here, right? Because a big chunk of Coinbase's business at the end of the day is still altcoins, is altcoin activity, right? And that trading activity. And they're in that's a precarious spot. I think the retail demand to trade those coins has really pulled back a lot. Yeah. And so we'll definitely be looking for any commentary they can give us on that. They're trying to diversify their product suite to actually sort of be less correlated with crypto prices and crypto activity. I don't think anything's going to show up that's all too moving for Q4 and likely not too moving in the first couple of months here of 26. But we would like to see their framework for prediction markets, some of these other assets beyond crypto, where you can grow in that, how you're looking to try to become a super app to compete more squarely with Robinhood. And then the stablecoin business should be relatively in line. I mean, that's pretty easy to model out and estimate. It's a great business, right? Because it's very stable for them. USDC supply, that market cap, has come down, but not all too much. They likely lost maybe a little bit of share to start the year versus Circle. But relatively, that should be a fairly strong business segment for them, or a stable business segment. I think where it gets a little bit more concerning too, and what we'll look for is where some of these bills ultimately shake out, right? Because Coinbase is in the unique position where you have the trading business that you don't want restricted, right? You don't want DeFi restricted, but then you also don't want that yield payment on stablecoins restricted, where most crypto companies aren't in both. Like you look at Robinhood, they don't care as much about the yield on stablecoins, right? And then maybe Circle cares about that, but doesn't care as much about some like trading restrictions because they don't have a brokerage business. So Coinbase is one of the few companies where it's almost negatively impacted with any kind of consolation, right? So Brian Armstrong needs that bill to basically go his way, or his business gets negatively impacted versus what they're doing today.
Yeah, I'm glad you kind of led into that, because that's where I was going to take the conversation next. The Clarity Act and the yield issue with regards to stable coins. I think we've reported on it ad nauseum, and it's one of the worst kept secrets, at least in crypto, that Coinbase makes, I think, some like orders of magnitude more from USDC than Circle does, because of the distribution costs and the I guess the yield sharing that they make from it. So if that goes away, that could be a significant problem. And I'm curious how you try to model something like that when you're figuring out what to do, because it's such a binary outcome. Like, it's going to go one way or the other, and you kind of have to live in this multiverse and plan for both. I mean, how do you account for that?
Yeah, I would say it's very hard to determine how much USDC on Coinbase is ultimately just to get yield, right? I think we can get numbers and say, okay, a large chunk of it is getting yield on Coinbase, but that's not the same thing as, hey, you're going to pull assets off Coinbase if you're not able to get that yield. So maybe you have USDC on Coinbase for other reasons, and there's an opportunity to earn yield. So of course you're going to lock in and sign up for that. But I don't know if it's necessarily the same thing as the only reason you have USDC on Coinbase is because they're paying a yield. I would think, though, there is a not negligible chunk that likely does leave Coinbase if they're not able to offer those rewards on USDC, or if there's not some loophole that they can try and utilize to do that. So I would think that that's fairly negative, which is why Brian Armstrong would say, hey, no bill is better than what he would term a bad bill, and a bad bill is the one that impacts their business. And that's because right now they can do both, right? There's kind of unfettered activity in DeFi. There's kind of no real restrictions there. So Coinbase and these crypto companies can benefit from DeFi continuing to grow, or just not contract as much as it otherwise would have. And then you can also do the yield component. So it's hard to determine really kind of how much USDC leaves the Coinbase platform, but that's where they get the benefit. The way the Circle Coinbase relationship works is if the assets are held on Coinbase, they get the full share of the interest income on that. If it's on third-party platforms, they split it 50-50, less any kind of distribution payments to those like Binance. And so if you do see USDC siphon off from the Coinbase platform, then that interest income, where they receive 100% of it, does go away. Yeah. Now they're also paying out on that too. So it's not like you get the full 100% effectively.
Understood. And then just quickly, because we're almost at time here, going back to sort of like the, I guess, negative sentiment in particular surrounding altcoins and how that could impact Coinbase's trading business, which is still obviously its main workhorse. Wondering, I know they just announced their partnership with Kalshi. I'm not even entirely sure how up to date it is, or how far off the ground it is. I mean, they are moving into a couple of other areas. They've launched a perps business. They're getting into tokenized stocks. I mean, they're doing some more agentic commerce stuff, especially on Base. Are there any particular markers, signposts that you kind of want to look for? You want to hear to get a sense of, even if it's early days, the type of traction that some of those new offerings are getting?
Yeah, we would love to start seeing, one, just commentary on customer adoption. So is it new customers coming onto the platform to participate in prediction markets? Is it existing customers going into prediction markets? Is it cannibalizing? So would management expect more prediction markets related to crypto? And that's not great, because that just means the crypto person is expressing a view a different way. And so maybe it cannibalizes the traditional trading volumes. Is it more, sports folks? So that's what we're mostly going to be looking for. And then any growth in that activity. Robinhood just had one of their best months ever. I think January was their best month ever in terms of prediction volume. So that's a positive tailwind. Would hope to see some of these other companies replicate that as well. Like Gemini now has prediction markets, right? Mm-hmm. What I would say, though, is it's starting to become fairly commoditized in that, Robinhood has these. It's not like if you roll this out, you have something that Hood doesn't have, and vice versa. You are starting to see, it's just kind of competing for market share at some point here versus total gains.
Okay, gotcha. All right. Well, one last one, and it's a hard one, so I want you to think carefully. All right.
Okay.
You ready?
Yeah, I'm ready.
All right. What did you think of the Coinbase Super Bowl ad?
Oh, so I actually didn't catch it live. I didn't have the Super Bowl on for the full time. I only caught a little bit of it, but I did see a lot of the reaction in fairly real time on different social media networks. I think what concerned me the most was just how much, like, your average person is not a big fan of crypto right now. So I didn't love that. I mean, sentiment's obviously way low in crypto, but it was very negative. It's almost your average person, I think, has a very negative view of crypto and crypto companies. And maybe to some extent, rightfully so. Like, meme coins didn't really pan out. A lot of folks likely lost money there. Crypto is down a little bit in the dumps. I would say the only positive takeaway is sentiment's really low. And when sentiment gets really low, that usually means, it's a good time to buy crypto assets. But in terms of volumes coming back, and in terms of Coinbase attracting more everyday people who want exposure to crypto, there's likely some room we got to go to get your average retail person where they like crypto and are interested and excited about it. Because it did seem like the reactions, just a lot of these people's reactions just immediately seem negative, which I was a little surprised by.
Well, let me, not that you asked, but let me tell you my experience with it. So we're watching the game, and my daughters say, "Why are they playing an old-fashioned song on TV?" And I'm like, I think I was 18 or something when the song came out. So I immediately felt old. And then I didn't get it. So I texted someone at Coinbase in PR to ask them what was the point of that ad, because maybe I'm just not cool and I didn't get it. And then they told me it's basically a way to kind of like hoodwink people into being like Coinbase. And I got a lot of people talking. I guess that's the point of the ad. Although it's tough to sell something when it's so. Hopefully, you have to be brave.
Yeah.
You have to be brave to buy. But it did get a lot of people talking. So we'll have to see what happens, and we will leave it at there. John, as always, thanks for joining us. And thank you to everybody for watching and listening. Please stick around because I'm going to be coming back in a couple minutes with Zach Pandl, the Director of Research at Grayscale, to talk more about how Bitcoin and tech stocks are trading and the divergence between Bitcoin and gold. And I'm going to get his reaction to the Super Bowl ad too. So please stick around. We will be right back.
That's good. Thanks, Steve.
This episode is brought to you by Adaptive Security, the first cybersecurity company backed by OpenAI. As AI becomes more capable, attackers no longer need to break into your systems. They just need a convincing imitation of someone you trust. That could mean a deep-faked voice on a call, a synthetic coworker on Zoom, or phishing emails written by AI that are nearly impossible to distinguish from the real thing. Adaptive's platform is designed for this new reality. It runs deepfake, vishing, and AI-generated phishing simulations so your team can see exactly how these attacks work and practice responding before it happens for real. Their AI content creator also turns new threats or compliance updates into interactive, multilingual training within minutes. You can learn more at adaptivesecurity.com.
If you're looking for help with crypto taxes, Crypto Tax Girl is offering $100 off for Unchained listeners. They provide personalized crypto tax reports and returns, and spots before April 15th are limited. Go to cryptotaxgirl.com/unchained to save $100. Once again, the link is cryptotaxgirl.com/unchained.
All right. Hi, everyone. Welcome back. As promised, I'm here with Zach Pandl, the Director of Research at Grayscale Investments. And unfortunately, he's a fan of the New York Giants and also the Green Bay Packers, two teams that haven't had success in a little while. And he has to deal with me talking about my Eagles, who are just one season removed from winning their second Super Bowl championship. But as I promised, Zach, what did you think of the ad?
Hey, Steve. Hey, everybody. Thanks for tuning in. Look, maybe I just have positivity bias, but I love the ad. I thought it was great. I was in a big party with, friends of family, their kids, my kids, that sort of thing. And everybody kind of stopped to listen and started humming and singing along, not sure exactly what was going on. And then we were all surprised when it was Coinbase. So I don't know how successful these things are. I'm not a marketing guy, but in terms of, we're in an attention-starved kind of world and very hard to break through. At least in the event that I was at, it definitely broke through more so than anything else that came up on screen.
Got it. Okay. All right. So let's get into it. You published an interesting report this week, really talking about how Bitcoin has been trading more like tech than gold, despite its sort of prevailing narrative as a form of digital gold. There's been plenty of times, as you've pointed out, that it tries to sort of thread the needle or straddle the lines between both. But right now, it doesn't seem to be trading like gold at all. And as opposed to trading up when tech goes up, it's going down with tech. So talk to me about what you saw and what you wrote.
This is sort of the key observation. And let me just talk about the facts first and the narrative piece second. And I think that's maybe the more challenging part. But the facts are relatively straightforward. The price of Bitcoin, went up with other frontier technology assets, and it went down with those types of assets as well. And this is software companies. This is defense tech. This is quantum computing stocks. I think that's an important point to emphasize. The charts look very similar with, quantum stocks and price of Bitcoin. And what that tells me is there's not something wrong with Bitcoin per se. Nothing has changed about the functioning of the network and all the particulars, and we can talk about all of those things. But what changed was risk-taking in markets. And I think it was a pretty clear tell that the marginal investor that came into Bitcoin in the last couple of years probably was a growth portfolio of some time. And we can talk about, again, the narratives, but I think growth investors see public blockchain technology as a secular growth industry. with tailwinds, regulatory tailwinds, adoption tailwinds related to stable coins, tokenized assets, these sorts of things, and bought Bitcoin, bought Ether, for that reason, to build it into a growth portfolio. And as those types of portfolios were de-risking, that meant de-risking in crypto, selling crypto also. So I think that's transparently what's going on in the market, and not something broken about crypto. What it is a challenge to the narrative. It's a challenge to the digital gold narrative, at least over the short term. Price of gold, price of silver were running earlier this year. And I certainly consider myself a deep believer in this idea that macro imbalances are driving demand for scarce commodities, and that crypto should be considered part of that thesis. So it was sort of a disappointing to people that own Bitcoin for that purpose, as a dollar debasement type of thesis, and didn't perform as you would have expected in that sort of scenario. So it's a challenge to the narrative. I don't think it's a challenge to the technology, and I still believe in that thesis, that narrative in long run. But those are the facts that I think, what is causing some, debate for sure, and puzzlement among many Bitcoin investors at the moment.
Mm-hmm. I'm curious, like your thoughts, because we talk a lot offline, but we haven't had a chance to speak about this. All the rumors, are maybe more than rumors, retail buying of gold in particular from the Chinese market, because we track central bank buying. And in fact, some central banks have been deleveraging their gold because of the price appreciation has been so high that they have to sort of maintain certain portfolio allocations. Yep. Are there any sort of like market structure imbalances like that, for lack of a better term, to explain why certain precious metals are going up and Bitcoin's not? I mean, Bitcoin is obviously banned in China, even though I know there are ways for people to get it.
I think in this case, it's more about the things that were causing the squeeze on the metals side, rather than something problematic necessarily with crypto. Of course, in the crypto asset class, the exposure and the access are getting broader and broader. Grayscale, an important piece of that story, introducing more ways to access crypto through ETFs and all this sort of thing. Your listeners very familiar with kind of the Grayscale story in that regard. But what you did have was some squeeze happening in the metals markets. Some people are familiar with this, but if not, the kind of backstory is that the U.S. threatened tariffs on lots of different products, including potentially precious metals. That caused some precious metals to leave the London market, come to New York to avoid potential tariffs. And so when you had speculative inflows into the ETFs, into other things, there wasn't necessarily enough inventory to meet that demand, and you got really squeezy price action, this sort of parabolic move in silver, and then a big retracement, and it continues to fall today. And I think that tells you that while there is clearly demand for scarce physical commodities related to the debasement trade, and I think that that's something that continues for many years, frankly, we probably shot by a significant margin on speculative capital inflows and shortages in the London metals market. And so we've given that back. I think my own view would be precious metals trade kind of weak for the short term for those reasons. I think we overshot. I think there's retail losses there. The correlation with stocks is now positive, just like Bitcoin. So everything is kind of de-risking. Crypto often moves first. It hit us obviously significantly over the last couple of months, now affecting precious metals. I think these are some of the same market dynamics at play.
Okay. All right. So just have a couple of minutes here, but I want to look ahead a little bit. The FT actually had a really interesting headline. I think it was earlier this week. It was something along the lines of the rise of the everything but tech trade, because there were these huge sell-offs from, I guess, fears about the big capex for the AI developers that I spoke about with John earlier, and then the impact of what that could mean for like tax software companies and the like. So if we're in this world where people are selling off in tech, and Bitcoin is now trading with tech going down, what do you see happening next?
That's a great question. I'd love to tackle this. Look, in markets, you very often see a shoot first, ask questions later type of dynamic. You worry about AI disruption, and the first instinct is to retreat from all types of software stocks. But I think the next stage is going to be a more thoughtful differentiation between the things that seem most likely to be disrupted by AI, or the legal and compliance barriers are lower in some sorts of way, and they're more readily disrupted. And then things that are not obviously readily disrupted, or maybe even complementary to AI. They may be software, but it doesn't mean that they're disrupted by AI. Right. There's a lot of things going on in crypto, but I do want to emphasize that I think public blockchain technology is more like the latter than the former. It's certainly not obvious to me why large language models are going to displace what public blockchain technology is doing. Creating trustless systems for finance is completely different than what AI models are doing. And I think there are some pressures from AI to crypto, things like privacy, is an important question, and what that means. But by and large, I think these technologies are complementary. That public blockchains probably will be part of the financial rails that AI agents are using. So I think what we had was a shoot first, ask questions later sort of dynamic, both in software stocks and in other things. Quantum is hardware technology that fell. Public blockchain technology is its own special thing. All of that stuff sold off together. I think you're going to see a differentiation trade looking ahead. My guess is, crypto, we certainly have some challenges that we're working through, but there's some potential positives. We get the market structure bill passed. If we see some, wealth platforms onboarding Bitcoin and Ether, we could find a sustainable bottom here and begin a recovery process. So that's my view. Differentiation trade is the next phase in following the sell-off that we saw really across the board recently.
Right, and that kind of leads just into my last question here. What does that differentiation trade look like? Tech was sort of a canopy across, or AI was a canopy across all of tech, but clearly now we're seeing some segmentation here. How long might it take for some of those lines to be drawn? What are the different sides, and like, how do you get Bitcoin to fit into the right narrative so that people sort of put it into the correct bucket when it comes to figuring out how assets should be correlated with each other?
The message that we are sending to our clients is that you should focus on the key fundamental trends, the mega trends in the crypto asset class. That's where you should be deploying capital. And what are those things? To me, those are regulatory clarity driving adoption of stable coins and tokenized assets, so a use case of public blockchains. And then what we're calling, maybe because it's easy to remember, the 3 Ps: privacy, prediction markets, and perpetual futures. To me, those are the innovation trends within the crypto asset class. So we're encouraging investors to allocate capital to those places first. So, the obvious beneficiaries of things like tokenization, stablecoins are the big smart contract platforms, Ethereum, Solana, and other critical middleware technology like Chainlink. These are things that are likely to benefit from growing adoption in general. And of course, there's lots of other assets on privacy, prediction markets, perpetual futures, Zcash, Hyperliquid. Your audience knows these as stories. These are assets that we are fond of with. So I think that there are important structural trends, and you're supposed to allocate capital to things that are most closely tied to those fundamentals.
Got it.
What about Bitcoin? Okay, I think needs to overcome to make sure that it is leading, if it's going to lead the asset class. And some of these things are the quantum question and its correlation to gold. If Bitcoin struggles to answer those questions over the short term, it's possible that the kind of asset that drove the asset class primarily to this point, begins to lag. We will see. We will see how that goes. But it's possible that in a scenario where stable coins and tokenized assets are really the thing, the engine driving the crypto asset class forward, that could be a scenario where Bitcoin specifically lags some other assets. So these are the kind of open questions I think are still unanswered at the moment.
Got it. Well, I think that's a great place to leave it, because up next, Laura Shin's going to be speaking with Ethereum Foundation researcher Justin Drake and a University of Michigan professor, Chris Peikert, to dive deep into quantum computing, the threat to crypto, and whether Bitcoin developers are underestimating the risk and how AI could pose some parallel dangers. So that's a really good way to end it. And the idea of actually Bitcoin falling into the caboose is that's a spicy take that I think people will be interested in digesting a little bit more. But Zach, as always, thank you for joining. Thanks to everybody for watching and listening. And please stay tuned for Laura's conversation, which will be up next.
Thanks, Steve.
We face of this very uncertain timeline of when and if quantum computers will emerge to the point where they can break our crypto is a very interesting kind of at an intellectual level, right? How do you apportion your resources? How do you measure the risk? How do you predict, well, we've got a long migration ahead of us. When do we start?
If you have the fast flavor, so for example, you have Google working on the superconducting stuff. The estimate for the time it takes to crack a key is on the order of minutes. Like
we face of this very uncertain timeline of when and if quantum computers will emerge to the point where they can break our crypto is a very interesting kind of at an intellectual level, right? How do you apportion your resources? How do you measure the risk? How do you predict, well, we've got a long migration ahead of us. When do we start?
if you have the fast flavor, so for example, you have Google working on the superconducting stuff. The estimate for the time it takes to crack a key is on the order of minutes, like roughly 10 minutes. And so what you could imagine is that Satoshi's coins would actually be stolen at the same rate at which they were mined in the early days.
Hi, everyone. Welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin. Thanks for joining this live stream. Before we get started, a quick reminder, nothing you hear on Unchained is investment advice. This show is for informational and entertainment purposes only, and my guest and I may hold assets discussed in the show. For more disclosures, visit unchainedcrypto.com. Quick note before we get into today's episode. Bits and Bips now has its dedicated feeds. We're spinning off from the Unchained feed and moving to a new podcast and YouTube channel. So if you want to keep up with our weekly live streams and macro meets, crypto breakdowns, make sure to subscribe to Bits and Bips directly. We won't publish there until March, but subscribe today so you can be ready for launch. Be sure to subscribe to the new feeds at unchainedcrypto.com/bitsandbips. Did you know that Figure is giving away $25,000 in USDC? They're a decentralized digital asset platform for earning, borrowing, and lending. Download the Figure Markets app using our link, figuremarkets.co/unchaineddp. Deposit into their democratized prime pools and earn about 9% APY paid hourly while you enter. Every dollar you keep in for 25 consecutive days counts as an entry. Again, the link is figuremarkets.co/unchaineddp for full details. If crypto taxes feel overwhelming, you are not alone. That's why Crypto Tax Girl, a team that's been helping crypto investors since 2017, is offering $100 off on one-on-one crypto tax help. To get $100 off your crypto tax services, go to cryptotaxgirl.com/unchained. Again, that's cryptotaxgirl.com/unchained. Today's topic is the quantum threat to crypto. Welcome, Justin and Chris.
Hi, Laura. Thanks for having us.
It's great to be with you, Laura and Justin.
So everyone, I know we're a bit late to this topic in the sense that others have been talking about this for a while, but we're also quite early because the threat to crypto that quantum poses is going to happen at some indeterminate point in the future. However, this threat is already influencing investment, and it is the kind of threat that will take a lot of coordination and planning to overcome, which is why we are discussing it now. So let's just start by laying the groundwork. Justin, why don't you start by explaining what quantum computing is and what threat it poses to crypto?
Sure. So quantum computing is a form of computing that leverages microscopic physics, if you will, that is hidden to the day-to-day world that we live in, but is very much present. And using this hidden structure, you can run computation theoretically faster for certain classes of algorithms, including algorithms that break the cryptography that we have right now in terms of elliptic curves. And the major threat for crypto is that it breaks the current cryptography that we have. So for Ethereum specifically, there's 3 pieces of cryptography that are vulnerable. The first one for user transactions is called ECDSA. The second one is at the consensus layer. We have something called BLS signatures. And then finally, at the data layer for the blobs, we have something called KZG. And the common thread for all these 3 layers is elliptic curve cryptography, which would get broken by quantum computers.
And Chris, how would you describe quantum computing and the threat that it poses to crypto?
Yeah, I think Justin said it perfectly. And this is a technology that is still in somewhat early and even speculative stages, but there's been a lot of progress in building these quantum computers by efforts that have invested billions of dollars toward engineering these devices. And at a theoretical level and also at an engineering level, we know and have known for several decades now that quantum computers, if they are built at large enough scale, can and would break all of the cryptography that we've been using heavily on the internet and in blockchain applications and all around the world for several decades now.
And so I know timelines can be difficult to project, but I was curious when you both personally thought that quantum computing would pose a threat to crypto, how many years from now? And either of you can answer.
Sure. Well, I started kind of going all in on quantum resistant cryptography research about 21 years ago. So at the time I thought, this is going to matter. This is going to be important someday. In those 21 years, we still haven't seen a quantum computer, but the level of effort and investment that's gone in has really skyrocketed in recent years. And so most people who are experts in this domain, I'm not sure I consider myself one of them in terms of actually building quantum computers, but most people who are experts in this domain do believe that we will have them at some point in time. And those timelines range from, well, how likely do you think a quantum computer is to emerge within a certain amount of time? So I think most people believe that, in the next 3 to 5 years, very unlikely. But perhaps at the 10-year, 15 years out from now, it starts to become more of a significant probability. And then predicting the future, even 20 years out, is a fool's game. I don't think anybody can do that.
Justin, what do you think of the timeline?
Yeah, so at the Ethereum Foundation, we've been thinking about this since 2018. We actually gave a large grant, several millions of dollars to Starkware back then to start building this technology. And with all of the progress that we've seen recently, both on the quantum computing side of things, but also on the algorithmic side of things, my personal date is now 2032. And I've partially stolen this from a friend in Cambridge who happens to be the founder and CEO of Riverlane, one of the top error correction companies in the world. And we both have a son sons who are in the same class, which is how I met him. And he's been in this space for 15 years. And his date 15 years ago was 2032. So I'm feeling pretty good about it. And going back to what Chris said, like very few people believe that we're going to have so-called cryptographically relevant quantum computers by the end of this decade. So we're talking 2030s. But I think there's a reasonable chance, for example, that in 2031, maybe a 1% chance, 2% chance, maybe more, that we'll have a quantum relevant computer. And then it really increases steeply the probability of having a cryptographically relevant quantum computer. And one of the things that I can share is that there's been this really big improvement on the algorithmic side of things. So if you rewind the clock 2-3 years ago, the best known algorithm for breaking Ethereum cryptography required about 10 million physical qubits. And then about a year ago, so last year in 2025, we had a paper bringing that down to 1 million qubits. And in 2026, we're going to have another paper that brings it down even further. And so I wouldn't be surprised if the end game is much closer to 100,000 qubits. And so we have these two curves eventually will cross. And because of the time it takes to migrate to new cryptography, we have to be thinking about this several years in advance. And if indeed I'm right that 2032 is the date, then today is when we really need to get started.
And explain what a qubit is.
So a qubit is the fundamental quantum building block, which is the equivalent of the bit. So a bit can take two values. A qubit can be in a superposition of states, and it can also be entangled with other qubits. This is what gives it its power. And when we talk about qubits, there's two flavors. There's the logically perfect qubit, which we call a logical qubit. And this is what the theoretical quantum algorithm designers will be using. And then you have what's called the physical qubit, which is the physical instantiation using atoms or photons or whatever it is. Because of the noise involved, you have to do so-called error correction. So you have to take a collection of physical qubits in order to form one perfect logical one. And this ratio between physical and logical is very important, and it might be on the order of 1,000 or 100 or maybe 10,000. This is very much in the engineering stage. But one thing that we should expect, in addition to the algorithms improving, is that the error correction will improve so that the ratio will improve. And of course, we should see more and more physical qubits in the same way that we have Moore's law that increases the number of bits and transistors that we have on a single chip.
Okay, so as you said in the beginning, the threat that quantum computing poses to crypto is kind of limited to a certain area. Just explain what that means in practical terms. Like, what are the actual dangers that everyday users would perceive, that businesses would perceive? What are the things that could happen if the crypto industry and all these different chains don't, come up with ways to, protect themselves against the quantum threat in advance?
Long story short, with a cryptographically relevant quantum computer, you can take a public key and recompute the private key from that. So normally, you're meant to keep your seed phrase secret and your private key safe, and you only expose the public key. But if we have a cryptographically relevant computer, it's basically game over. It's systemically bad for the whole industry, where the notion of property rights starts to crumble.
Yeah, I would add that cryptocurrency is built on the foundation of secure cryptography. And there's all kinds of cryptographic primitives and tools by various names, digital signatures and hash functions and encryption and all these different kinds of tools and primitives that we use so that we can build a secure cryptocurrency. And when that foundation crumbles and becomes completely insecure, well, everything built atop of it also collapses. So it is, as Justin said, a completely systemic risk, as well as a particular risk to specific protocols that are out there, whether they be Ethereum or Bitcoin or any of the many other kinds of blockchains that are out there.
And so essentially, like, it's something like whoever creates the first quantum computer could steal as many coins as they want from pretty much any chain. Is that sort of the doomsday scenario?
That's a fair description of what would happen, right? If you can take any public key off of the blockchain, you could empty its account, right? And just forge a transaction that transfers all the assets from this account to the account of your choice. Those are some of the very simple to imagine consequences of having a cryptographically relevant quantum computer. There are other sort of more subtle or nuanced situations, like one could potentially use a quantum computer to break consensus or cause some kind of fork in certain types of blockchains that are protected by digital signatures that are vulnerable to quantum computers. So Justin also mentioned this at the beginning. The actual consensus layer of many blockchains is protected by cryptography that would be broken by quantum computers. So, whether an attacker would actually want to do this and destroy the entire consensus of the network or not is an open question, but it's at least something that in principle could be done. And so that would be a systemic destruction of maybe all the value in that blockchain.
I do want to kind of share some of the nitty-gritty details of quantum computers. So there's several so-called modalities, which are different flavors of quantum computing. There's, for example, trapped ion and neutral atoms, and those involve like moving particles around, and they tend to be relatively slow in terms of their clock cycles. And so if you were to run the algorithm to break our cryptography, known as Grover's algorithm, it might actually take several hours or several days. And so if you only have a limited number of quantum computers at the very beginning, then you should only expect a small number of keys to break if these are the modalities that are going to win. There's other modalities, for example, supercomputing and photonics, that are much faster because there's no moving parts. And here you could expect a key to break in a matter of minutes. But again, if there's a limited number of sufficiently powerful quantum computers, most addresses will actually be safe because, for example, Satoshi has a very large number of addresses, each with 50 Bitcoin in the early days of mining Bitcoin. And so one very easy mitigation actually is to just make sure that in your wallet you have less than 50 Bitcoins worth of value, because then the attacker will target Satoshi's coins first and will have a bunch of lead time seeing Satoshi's coins being drained before everyone else's.
Wow. Okay. Yeah. I mean, the one thing, of course, is if Satoshi's coins get drained, then that would cause like a systemic panic, and so the price of Bitcoin might go south. But let's say that now it was 2032. We would wake up one morning and like find out that all of Binance's wallets got drained, even like cold storage. Same with Coinbase. Is that kind of how to think about it?
So a lot of the large exchanges for their cold wallet actually implement a very easy mitigation, or at least they should implement a very easy mitigation, which is to not reveal the public key. So on most blockchains like Bitcoin and Ethereum, you have the address, which is the hash of the public key, and then you have the public key, which needs to be revealed the very first time you spend from that address. But if you have a cold storage address for which you've never made any spends, then the public key has not been revealed, and that's actually secure against quantum computers. So the very easy mitigation is to make sure that you're hiding your public key behind the hash, which is your address. Now, there is a company called Project 11 that has this tracker website that will tell you what percentage of keys are protected behind the hash and those that are not. And I believe we're talking roughly 30%. Don't quote me on this, just check the website. And some of the top addresses are indeed exchanges. So if you are a security officer at one of these exchanges, or you're part of management, do consider this very simple mitigation of putting all your cold storage in an address that has never made a single spend.
Okay. Okay. Yeah, I guess from what I understand, the way these exchanges work, they have cold storage, they'll have like a lukewarm storage, or I forget what it's called, and then the hot wallet. So presumably there are times when certain cold storage wallets might need to transact with the lukewarm wallets or whatever they're called, but yeah, it's probably pretty infrequent. Okay, so now let's talk about something that Chris kind of alluded to. He said, if whoever develops the first computer wants to go after these coins, I'm so curious. There must be a race to develop this type of computer first. So who are sort of the different players, and are any of them ones that, might be motivated to attack crypto?
Sure. Well, we know of many of the public players, at least. Google has a serious high dollar investment in building various types of quantum computers, engineering them. And as Justin mentioned before about error correction, just last year, Google had a major breakthrough in the quality of error correction that it was able to attain. That's one of the most important ingredients in ultimately building a large-scale quantum computer. You also have IBM and a moderate number of startups of various names that are all trying different engineering approaches. And then you have the not-so-public players. We know that governments around the world of various large countries are very interested in this kind of technology. They don't report out their progress to a large degree. And so we don't really know where they lie, and whether the private sector that's making public announcements is ahead of them or catching up. It's very hard to say. But naturally, the U.S. government, the Chinese government, all kinds of rich countries are almost certainly investing a lot of effort into building quantum computers.
Yeah, and in the public quantum computing industry, there's a bunch of companies that have gone public, and there's been a little bit of speculation around those. So some names that Chris didn't mention, there's like PsiQuantum and Quantinuum and Rigetti. Now, I was talking to the Google team recently, and one thing they mentioned is that in China, instead of having many different commercial companies working on this, it's mostly centralized at the government level, and they're extremely quiet. So I would say those are the two primary poles: the public companies and the Microsofts, the IBMs, and the Googles, versus a government like China.
Yeah, I feel like this is sort of something that's been said a lot in crypto, but a government like China is probably one of the few players that would be very motivated to try to attack blockchains in this way. So yeah, I could see that being a threat. Okay, well, I'm so curious, and I know you guys are kind of affiliated with certain chains, but you probably have made an assessment of which chains are maybe more vulnerable than others, and which ones are least vulnerable. So I'm just curious to hear the lay of the land, like what your opinion is on if there are any particular coins that you think probably are better positioned, and which ones need to up their game.
So when migrating to post-quantum cryptography, there's really two challenges. One is a technical one, and the other one is a social one. In my opinion, the major technical challenge is what's known as the size problem for post-quantum cryptography. We're dealing with signatures that are at least 10 times larger than ECDSA. So ECDSA has 64 bytes signatures, and the smallest NIST standardized scheme is called Falcon 512, and it has signature sizes of 666 bytes. And then there's all sorts of other schemes that have even larger signatures. And so if you maintain the block size, which for pretty much any blockchain is like the scarcest resource that you have throughput, and you increase your size of your transactions by a factor of 10, then your TPS, your throughput, is going to go down by a factor of 10. So imagine Bitcoin going from 3 TPS to 0.3 TPS, or Ethereum going from 25 to 2.5, or Solana going from 1,000 to 100. In my personal opinion, this is just a non-starter, just from a commercial standpoint. It would just be like way too disruptive. And so what the Ethereum Foundation has been investing in to solve this technical size problem is what's known as signature aggregation. So the idea is to take multiple, or all of the signatures corresponding to all of the transactions in the block, and to snarkify them into a single proof that would get published alongside the block. And this is something that we've been working on for a while now. We have something called Lean VM, and we have variants of the NIST standardized signatures that are much more friendly to this aggregation. Now, putting aside the technical problem, which is real, for some other blockchains, there's an even more real problem, which is the social one. First of all, they need to recognize that indeed there is a problem. And then even once they've recognized, they need to put in place all of the coordination infrastructure. And the top blockchain that I have in mind here is Bitcoin. You have leaders like Adam Back that are in complete denial that quantum computers could be coming in the early 2030s. He's talking about, at minimum, decades until cryptographically relevant quantum computers come. And Nick Carter wrote this report recently where he went through the whole list of Bitcoin high priests, and of the 10 that he identified, only one of them, Jonas Nick, was worried about quantum computers, and the 9 others didn't seem too worried. And Bitcoin is a chain that only makes upgrades extremely infrequently. In the last 10 years, it's only made 2 upgrades, and it's plausible that it would take them at least 5 years to upgrade to post quantum cryptography, and that quantum computers could come within that time frame. Now, one of the things that I'm hoping will happen, ironically, is that there's a collaboration between Ethereum and Bitcoin, because what happened in 2009 when Satoshi launched Bitcoin is that he created a de facto standard for signatures. So he went with ECDSA, he picked a specific curve, SEC 256, SEC P256K1, and then most of the chains just copied this. And this was really good because it meant that you had the same key derivation standards across all of the chains. You have the same wallet infrastructure, the same hardware wallets. You had the same MPC protocols, et cetera, et cetera. And it would be pretty catastrophic, in my opinion, if every chain were to come up with its own solution. And so the strategy that we're taking at the Ethereum Foundation is actually to try and pill the Bitcoiners to reuse whatever we have, so that if Bitcoin and Ethereum together have the exact same solution, that all of the other chains most likely will just copy it. And so the Lean VM that I mentioned is built with Bitcoiner security in mind. We're trying to be as conservative as possible, not cutting any corners. And we're also collaborating with Bitcoin researchers. So there's Michal Kudinov, for example. We wrote 4 different papers, academic papers, with him in 2025 and early 2026. These are papers on post-quantum cryptography. And last year, we organized a workshop in Cambridge in October. This was a 3-day post-quantum workshop, which he came to. He's a great guy. And I'm basically hoping that Michal can single-handedly be the bridge between the Bitcoin world and the Ethereum world. And I forgot to mention that Michal works at Blockstream, the primary company that has soft power over Bitcoin upgrades.
Yeah, and that is run by Adam Back, who actually you mentioned
That
earlier
is
was
true.
not, yeah.
But yeah, Jonas Nick is also at Blockstream, so maybe Adam Back could be convinced if Michal and Jonas join forces.
Okay, and I'm curious, Chris, what you think of that idea about if Bitcoin and Ethereum are using the same strategy or the same solution, if that would be something that other chains would naturally do, because I don't know if it is even an issue, but in my head, I'm like, oh, but does that reduce resiliency for the industry if everybody's using the same model that potentially could later on become vulnerable? I don't know.
Yeah, in terms of cryptography and the the standards that are underlying the technologies themselves, I think it's a very good thing to have broad industry standards that are well understood, that have been well vetted. And as Justin mentioned, the Falcon signature scheme is one which has been selected by the U.S. National Institute of Standards and Technology now through a many-year post-quantum cryptography process. So that started back in 2017 or so, and is just coming to the conclusion of its main activities in the past year and upcoming year. And so it's very good if the industry can all agree on one standard so that things are interoperable. You get many fewer cryptographic disasters or unexpected incompatibilities or security issues. Speaking of some of the other projects out there that have taken post-quantum cryptography seriously, for example, I've been connected to Algorand since 2021 through Algorand Technologies. That's a company that works on the cryptographic research and protocol security. And one of the reasons I got excited to do that at the time was they specifically wanted to understand the post-quantum cryptography landscape and to bring their chain up to date and understand what it would take to build in post-quantum resiliency. So through those years, we developed something very similar to what Justin was talking about to address this size problem. It was called state proofs, and it uses the Falcon signature scheme. And it basically offers a fairly frequent but periodic checkpoint, a post-quantum secure checkpoint about the state of the Algorand chain, for example. So it allows you to say, every 256 blocks, which is every few minutes on Algorand, you can get signatures, Falcon signatures from many, many different validators and accounts that attest to the state of the chain. And then there's a thing called a state proof that kind of condenses these Falcon signatures down to a small number of them that together prove that a large percentage of the stake in the Algorand system has attested to, yes, this is the state of the blockchain at this point in time. And that's a post-quantum secure attestation or proof. And so it allows one to, for example, interact with other chains or have a long-term post-quantum secure kind of snapshot of what the chain actually looked like. And that keeps it secure even in the ultimate future when quantum computers emerge and might try to, fork the chain through a historical path or try to convince a light client that the chain looks like this when it actually looks like that. So light clients and other users can look at these state proofs and determine, yes, this is the actual state of the chain at this point in time. And then recently, Algorand also added these post-quantum secured wallets, so you can actually give post-quantum secured transactions for using the same Falcon signature scheme.
Oh, okay. And for the transaction, that just means like that the transaction wouldn't be vulnerable to a quantum computer, or
Exactly. Yeah,
okay.
the signature transaction has a signature. It's a Falcon signature. That's a post-quantum secure signature. And the idea is that a quantum computer would not even be able to forge such a signature. It would not be able to, empty your wallet if you've got this feature enabled that requires post-quantum signatures on its transactions.
Oh, got it. Okay.
So these are addressing sort of the two layers that Justin mentioned at the top of the show, where you have, there's protection for individual accounts and wallets, and then there's protection at the base layer of the blockchain itself and the consensus layer. And does everybody agree that the same thing is happening?
Okay, got it. That makes sense. All right, so in a moment, we're going to talk a little bit more about some of the other efforts that are being made. But first, a quick word from the sponsors who make this show possible. Bits and Bips now has its dedicated feeds. We're spinning off from the Unchained feed and moving to a new podcast and YouTube channel. So if you want to keep up with our weekly live streams and macro meets, crypto breakdowns, make sure to subscribe to Bits and Bips directly. We won't publish there until March, but subscribe today so you can be ready for launch. Be sure to subscribe to the new feeds at unchainedcrypto.com/bitsandbips. Want a chance to win $25,000 in USDC? Figure, a platform to earn yield, borrow against crypto, and access lending markets, is running a $25,000 USDC sweepstakes tied to their democratized Prime product. Here's how it works. Download the Figure Markets app using our link, figuremarkets.co/unchanneddp, deposit into a democratized Prime lending pool, and leave your funds there for 25 consecutive days. Every dollar equals one entry, so $1,000 equals 1,000 chances. While your funds stay in the pool, you're also earning around 9% APY, paid out hourly. To learn more and enter, go to figuremarkets.co/unchanneddp, which is also available in the show notes. If you're looking for help with crypto taxes, Crypto Tax Girl is offering $100 off for Unchained listeners. They provide personalized crypto tax reports and returns, and spots before April 15th are limited. Go to cryptotaxgirl.com/unchained to save $100. Once again, the link is cryptotaxgirl.com/unchained. Back to my conversation with Justin and Chris. So, are those all the different types of, problems that could happen with quantum computing, or are there any others that, might affect blockchains?
There's another type of attack that we haven't really mentioned so far, and it's of lesser significance to the blockchain space, but still can have some important implications. And that is what's known as a store now, decrypt later attack. This primarily affects encryption. So if you have data that you want to keep secret, let's say your account balance is private, or you're using a chain that offers some privacy to the transactions, that usually uses a technology called encryption. And just like with ECDSA signatures that Justin mentioned earlier, all of the predominant encryption methods of the past several decades are also vulnerable to quantum computing attacks.
And so would that affect like pretty much all the privacy coins and all the privacy chains? Is that?
It might. It would depend on what kind of level of privacy that they provide. But what it would allow is if there's some encrypted data that is stored on the blockchain, for example, and is meant to remain secret for a long time, when a quantum computer ultimately emerges, it can look at that encrypted data, break the key, and decrypt the data and learn what was supposed to remain private. And so you have this problem where if you're encrypting things today with cryptography that would be vulnerable to quantum computers, you have a problem, because if you're trying to keep it secret for 10 years, for example, and quantum computers emerge in 6, or as whatever the prediction is, you're going to lose, right? You're not going to be able to keep it secret for that long. So it means that if you want to keep secrets for a longer term period, then you need to start using quantum secure cryptography right now.
Laura, you were asking about the privacy chains. So I have a piece of good news and a piece of bad news. The piece of good news is that quantum computers will break the soundness of these privacy schemes like Zcash, but they will not break privacy. So someone can spend coins that are not theirs, but at least the whole history of past transactions will not be like magically decrypted. So that's the good news. The bad news is that I think privacy coins like Zcash are going to be the very first target of a quantum computer. And the reason is that you can steal funds without anyone noticing. So within the privacy pool, you can just empty the privacy pool and no one will know. And so you mentioned, Laura, that there would be kind of mass panic if Satoshi's coins were to move. Well, there wouldn't be any mass panic if the Zcash coins were to move, because no one would really notice.
Oh my gosh. Yeah, that is that's really scary. Um and would this also affect, because there's, as I'm sure you know, there's a bunch of layer 2s that have privacy on Ethereum. I just interviewed Aztec back at DEF Connect when they launched, like that, there's a bunch. So would those also be affected?
Yes, unfortunately, they would be affected. And really the solution here is to try and migrate as quickly as possible to post-quantum snarks, because a lot of these are based on snarks. And hash-based snarks are basically the only solution that is production grade today. Now, in addition to deploying new technology, one of the social problems is trying to force the community to exit one system and move to another one. So, for example, in the context of Zcash, they have these multiple shielded pools. I think one is called Sapling, and they have various names. And one thing that you can do is basically keep track of the total amount of funds that have been deposited in the privacy pool and the total amount of funds that have left. And so you can, what you could potentially do is have a policy that says, by this date, we need to have this specific vulnerable privacy pool be emptied. Otherwise, all of the coins might be destroyed as a policy decision by the community. And one of the things that I want to highlight, going back to Bitcoin, is that they have this big issue around what do you do with the Satoshi coins, which is about 1 million BTC, which is tens of billions of dollars. And there's basically potentially going to be a contentious fork here, with one side wanting to burn them and the other side saying no, privacy rights are sacred, we definitely cannot burn them. The good news for Ethereum is that there's roughly speaking 0.1% of the ETH circulating supply which is known to be lost, or believed to be lost. And so that's essentially a rounding error, and I don't think we'll have this consensus fork in Ethereum land.
And wait, so I'm sorry, just to understand, are you saying for something like Bitcoin that in order for any coins to be saved, all the owners have to voluntarily move? No.
For any chain, we need to have the owners perform an action where they spend their coins from a quantum insecure wallet and migrate them to a post-quantum secure wallet. There is this one exception, which is that it is possible to basically have a proof of knowledge of the seed phrase as opposed to a proof of knowledge of the private key. And that would allow you to migrate without any user action. But this is not something that many chains are considering as the default path. They are considering it, for example, as an emergency path. So if, let's say, tomorrow we had a quantum computer that was able to crack Ethereum addresses at will, what would probably happen is that we would just shut down the chain, and then we would have a mechanism for people to prove that they own the seed phrase, which is a post-quantum secure thing, as opposed to proving that they know that their private key, because that's something that the attacker would know. And then we would have this reboot mechanism that would take several weeks, potentially several months. So yeah, it is being considered right now as an emergency backup, but it's not the default path.
Wait, and I'm sorry, to quote unquote shut down the chain, you have to get all the individual miners, or stakers, but I guess because there's a lot of, so you'd have to get all the solo stakers and all the, kind of like places like Lido and whatever that are doing it for individuals. Like you'd have to get them all to do that, right? Or
So there's two separate problems. There's the users and the validators. For the users, would basically the community more likely than not would say, hey, like any transaction that has been made from this point onwards is just considered a null and void. What we're going to do in order to prove your ownership of a specific address is we're going to ask you to prove that you know your seed phrase. So just to back up a little bit, the way that you go from the seed phrase to the private key involves some hashing, and hashing is quantum secure. So that step here is quantum secure, and it can be leveraged to do an emergency reboot for the users. You could also do a similar thing for the stakers. So Ethereum has roughly $100 billion of stake, and each validator can have a zero knowledge proof that they know the corresponding seed phrase, and then use that to basically send the ETH to a new post-quantum secure address. But this is a process that would take many weeks, potentially many months. And so for a period of time, the Ethereum chain would go down. But having said all this, the plan right now is to upgrade every single piece of Ethereum cryptography to be post-quantum secure by 2029. And so hopefully this should not be an issue if indeed 2032 is 2032 is the correct date.
okay, yeah. Obviously, you want to do it ahead of time because what you just described sounds like chaos. But um, Ethereum has done similar things in the past. Like if I think about the DAO hard fork, like there are messy situations that it's come across, and yeah, okay, maybe the solution was messy in its own way, but like it worked, basically. So okay, that's really interesting. So Chris, well, yeah, so okay, so now Justin just briefly gave us a little bit of a glimpse of like how Ethereum is thinking about trying to tackle this. Like, does Algorand have any plans, or do you know of any other chains that have like certain plans around, how to kind of transition before the threat arrives?
Yeah, there are, several chains that are thinking, I think, seriously or to some degree of seriousness about how to do these kinds of upgrades and transitions. I think it's absolutely important to do it very deliberatively and iteratively. So the approach at Algorand, for example, has been, let's deploy this state proofs, right, for the underlying consensus and chain and the long-term viability and accuracy of the chain. And then let's learn from that and let's iterate. And then they, moved it to post-quantum transactions, post-quantum protected transactions. We'll, learn from that and discover new techniques, new ideas that allow to move forward to other pieces of the picture. And so I think another reason to start early, in addition to the ones that Justin has mentioned about, the uncertain timeline of when are we going to be at Q day, right? When are we going to hit the Q-apocalypse, is you have to learn and you have to iterate and you have to try some things that might not work and adjust your approach because the performance profiles of these post-quantum schemes is very, very different from what people are used to with the current classical cryptography. So, the sizes are much larger. There's, on the plus side, verifying signatures is much faster in post-quantum schemes like Falcon. And so, for blockchain applications, fast verification is a very useful fact. You want to be able to verify a lot of signatures very quickly because there are so many of them on the chain. There are going to be a lot of tricky implementation issues with a lot of these cryptographic primitives. They work completely differently from what we're used to. And so all the lessons of the past actual, few decades in terms of sticky points and trip ups that people have made with insecure implementations and things of that nature, we may have to relearn some of these lessons or at least pay close attention to the mistakes that were made in the past and make sure we don't make versions of those mistakes again with the new cryptography. So, it takes a long time. All of these things are slow and deliberative, and one needs to start early because it's a marathon, right? It's not a sprint. You don't want to be sprinting for 26 miles. You're going to fall over dead at the end if you do. You'd rather have a nice, well, my pace would be 4 miles an hour if I were running the marathon, maybe less. But you want to be able to be going carefully and deliberately, and that means starting very early and going piece by piece.
And so, Justin, as you mentioned, the Ethereum Foundation just announced this post-quantum team. And, you kind of already gave a little bit of a glimpse into what you guys were thinking, but just like tell us a little bit more about your plan and, what goals you have.
Right. I guess before that, one thing that I want to share as a prediction is that I think the blockchain industry is going to suck in a lot of post-quantum talent in the months and years to come. One thing that it might not be clear to your audience is that Chris is like one of the very top experts in the world on lattice-based cryptography, and it's fantastic that he is in blockchain land working with Algorand. And Blockstream very recently hired Michal, and we, at the Ethereum Foundation, we had already a team of cryptographers, and we're increasing that. For example, recently we hired Emil to work on Lean VM full time. Now, the specific plan that we have is to solve this size problem via hash-based cryptography. So specifically, we're hoping to have hash-based signatures that are unaggregated, and then use hash-based snarks to aggregate the hash-based signatures. Now, why hash-based? The reason is that one of the primary reasons is that there's uncompromising security. One of the goals of blockchains is that they're going to be securing hundreds of trillions of dollars over centuries. And hash-based cryptography is believed to stand the test of time, and is by far like the most conservative and minimal assumption that you could hope for. And hashes in some sense are a sunk cost for blockchains. We have them everywhere. With our Merkle trees, even in signature schemes like Filecoin, which are called like hash and sign, you have the hashing that's part of the signing process. So we're going with like absolute uncompromising security, and again, that's part of the strategy to try and appeal to the Bitcoiners. Now, if you were to ask a person on the street or a cryptographer of the street, is using hash-based cryptography a wise choice for blockchains, they might actually say no. And the reason is that hash-based signatures are larger than the other flavor, which is called lattice-based signatures. So it seems paradoxical. Why would you choose the hash-based signatures? And the way that I think about this is that it's what I call the hash gambit. So where we have these larger signatures, but then we're solving the size problem with this other tool, which is the hash-based snarks. And what you end up with is a very small and fast to verify snark proof that you post with every single block. And the only place where the larger signatures show up is off-chain in the mempools. So there's a solution there which is called sharded mempool. So instead of having one mega mempool for all of Ethereum, we might have 64 mempools, each with 1/64th of the transactions flowing through, and that's perfectly fine. It's an easy design, but really the scarce resource that we want to be preserving is the on-chain data availability throughput. And for that, we would take all of the signatures and snarkify them. And ironically, when we do that, it's actually a scalability boost relative to what we have today. And the reason is that today we are consuming 64 bytes of ECDSA data availability per transaction, whereas in the future we wouldn't be having this fixed cost per transaction. And so if you look at a a blockchain like Bitcoin, the total amount of signature data that goes per block is actually larger than a single proof, which is on the order of 200 kilobytes. So that is the strategy, to take the hash gambit, have slightly larger signatures, but then aggregate them. And by going with hash-based signatures, in addition to the uncompromising security, we also have very elegant designs. So hash-based signatures are some of the simplest things that you could imagine. They were actually invented close to half a century ago. So a small historical fact is that Ralph Merkle invented Merkle trees in 1979. And what was the context of that? It was Merkle signatures, which are hash-based signatures. And what we're hoping to put in production at the consensus layer is basically a small variant over these Merkle signatures. So we've been taking the Merkle tree part of his invention that's almost 50 years old in blockchains, and now we're kind of going back to the roots and also using it for signatures, which is a fun anecdote. And in addition to the security and the elegance, there's a third advantage of hash-based cryptography, which is that it's been heavily deployed in production. Hash-based snarks, sometimes known as starks, are the common now the de facto standard for snarks for rollups, for example, and they're extremely performant, and certainly performant enough to be able to aggregate the signatures for all blockchains.
Okay. And what you just explained sounds so interesting, but I'm sure Chris, being an expert in a different type of, I guess, post-quantum computing, I'm curious, Chris, what your thoughts are on that, and if you can explain, what a different way to approach it might be, and not just for Ethereum, but for any chain.
Sure. Yeah, it's a really exciting time because there's such a wide spectrum of possible solutions to these problems we face, and there's a lot of different trade-offs that emerge, and that in one context may make a great deal of sense, and in another context, don't make any sense at all, right? So I think the system that Justin just described sounds really cool. It's these hash-based signatures are, as he said, one of the oldest and most classical things you teach in Crypto 101, and often things in Crypto 101 that we teach, we say, oh, this is like a completely theoretical thing because it's so inefficient. But then with a bunch of engineering and a lot of hard work and very clever systems work, it turns out, hey, this is completely practical and you can do it in reality. So that's what's one of the exciting parts of this post-quantum cryptography field for me and many others, I think, is there's like 1,000 flowers blooming all over the place, and oh, look at this one, it looks completely different from this one, and it has its own like cool advantages, and you can do these kinds of things with it, which, well, we could never do that before. Or it's got a very fragile stem, well, okay, we can like shore up the stem and make it much more strong with this other tool, right? So all these combinations of really cool, almost magical cryptography allow you to do these sort of miraculous things. The area that I work in is called lattice-based cryptography. And in addition to hash-based cryptography, those are the kind of two categories that of schemes that NIST did ultimately select for its standards, its post-quantum cryptography standards. So both areas are old-ish. Lattice-based cryptography goes back to the mid-1990s. So it's kind of getting long in the tooth as well, which in cryptography is a good thing. When something's been around a long time, that generally means it's stood the test of time and can be considered to have good security. People have looked at it for a good deal of time, which is necessary before you start putting billions and trillions of dollars of assets at work secured by such cryptography. So the other thing I love about lattice-based cryptography is maybe some things we'll be talking about in 5 or 10 or maybe even 3 years, it has these amazing other features you can do with respect to privacy and what's called fully homomorphic computation, fully homomorphic encryption, that enables all kinds of miraculous applications. It's still in the relatively early days of being practical enough to deploy, but there's been a great deal of effort on it at the scientific side and the engineering side over the past 15 years, or even getting a little bit more than that. And I think in 5 and 10 years, we will be pretty amazed by what we can do with those kinds of technologies as well.
All right, so now let's talk about Bitcoin because that's really the chain that kind of kicked off this conversation. As Justin alluded to, Nick Carter of Castle Island Ventures a few months ago released, a bunch of different essays, and he talked about how he had done a bunch of interviews and he felt like the Bitcoin core devs were not really taking the quantum threat seriously. And he found that concerning because it's the most decentralized chain with I guess what you could say is least codified governmental infrastructure or practices for decision making and group action. And obviously, Bitcoin is easily the most important asset in crypto. And I just wondered if you had thoughts on what he was saying. Justin, as you mentioned, some of the people who are very prominent in Bitcoin are a little bit dismissive of this threat. And I wondered, if you felt that, Nick maybe kind of was making a stronger point, or if you felt like you agreed more with the Bitcoin devs, or how, and either of you, can answer. But I'm just curious for you to describe what you think are the quantum threats to Bitcoin.
I think Nick is directionally correct on pretty much all of the points. I guess I would add 2 caveats. The first one is that there's this weird game theory where maybe the Bitcoin developers don't have an incentive to talk about the risk, even though they themselves kind of personally, privately appreciate the risk. And I think there might be something similar going on with the security budget. I know, with very high confidence that Bitcoin is not going to stand the test of time because of the security budget and the happenings. And there's some very smart people that probably understand that, but don't have an incentive to speak about it. And maybe we see something similar with quantum. The other thing that I want to kind of push back on a little bit with Nick is that there are like a couple of very smart people that are taking it seriously, especially Mikhail and Jonas. And at the technical level, you don't need an army of researchers necessarily. A small group of people, especially with the advent of AI, can do a lot. I think there is a reasonable path here where in parallel to mainnet, there's some test nets or some dev nets that are led by people like Michal and Jonas, and that thanks to companies like Project 11, there is a reasonably swift migration. Now, one of the data points worth sharing is that if you're going to cycle through every single UTXO on Bitcoin, it's going to take about 3 months if the chain is dedicated to doing nothing other than cycling through these UTXOs. And so, realistically, maybe we're talking, more like a whole year to do the migration. But yeah, I think the bigger issue is going to be how are they going to solve this aggregation problem. There's the technically naive way of solving it, which is just increase the block size 20x to kind of counterbalance the fact that the pub keys and the signatures are that much larger. But there was a whole holy war that was fought on Bitcoin block sizes, and the small blockers win. And I think it would be not super palatable to increase the block size by 20x. And so the solution that I'm presenting to the table for Bitcoiners is maximum security with hash-based signatures, a solution which gives them a scalability boost over what they have today and doesn't require them to increase the block size. So my hope is that in the 3-day post-quantum workshop that we're organizing again this year, we're going to have more than just one Bitcoiner, hopefully a handful of them. And if you'd like to come, my DMs are open, and I'd be more happy to host you.
Chris, what do you think?
Yeah, I mean, I would say at sort of higher level, just backing away from the specific situation of Bitcoin, in the issue that we face of this very uncertain timeline of when and if quantum computers will emerge to the point where they can break our crypto, is a very interesting kind of at an intellectual level, right? How do you apportion your resources? How do you measure the risk? How do you predict, well, we've got a long migration ahead of us. When do we start that is really a challenging thing. And so, reasonable people can come to different conclusions about that in their own context and projects. But I think overall, I would say there does not seem to be any intrinsic blocker to quantum computers eventually scaling up to break cryptography. I think more and more people are coming around to the idea that, it's a matter of engineering. It's a matter of, are people going to put in enough budget to actually engineer these devices? And the directional that seems to be going is, yes, it's going to happen sooner or later. And technology is very hard to predict. We have many examples in history where technology came on much faster than it was maybe expected to. And we have many instances where certain technologies took a lot longer to come out than some of maybe the reasonable predictions had made. So
I did want to ask about the issue about Satoshi's coins, which we brought up earlier, because Satoshi has such a large number of coins. And from what I understand, the coins that Satoshi mined have a public key structure that is more susceptible to the quantum threat. And obviously, because of the high dollar value on that number of coins, that would be something that maybe somebody who developed quantum computing early could be motivated to attack first. So
could be the canary in the coal mine. Yeah.
So I'm curious, do you feel like Satoshi's coins in particular pose sort of a unique threat that Bitcoin out of all the blockchains has, or do you, I don't know, what do you think about that?
Yeah, I would say it is unique. It's 5% of the Bitcoin supply, and I don't know of many chains that have such a large amount of believed to be lost coins for which the public key is exposed. As I mentioned previously in the show, the equivalent number for Ethereum is 0.1%, so about 50 times less of a problem from a quantitative standpoint. But because the delta is so big, it has qualitative different consequences. So in the case of Bitcoin, it's going to be a whole debate. It's going to be a contentious fork. In the case of Ethereum, it's going to be a rounding error. No one's going to care that 0.1% of the coins are going to get stolen.
Okay, so even though we've kind of been arguing that Bitcoin maybe has a little bit more of a threat, 21 Shares just came out with an essay that I wouldn't say they're minimizing the threat, but they are saying at least that they feel the way that it's been portrayed has been overstated. And so they did an analysis, and they're actually saying that they believe only 10,000 to 20,000 Bitcoins are actually going to be vulnerable. And that only that they said, so about 10,000 would be able to be suddenly, quote, suddenly and unexpectedly brought to market from compromised private keys. And the remaining coins sit in 24,000 individual Bitcoin addresses that hold about 50 Bitcoins, and that it would take decades to steal those, quote, even with the most wildly optimistic technological breakthroughs. So So in that regard, then it sort of felt like, oh, maybe the threat has been overstated. I don't know. What did you think of their analysis?
I haven't read their report, but I can imagine what they're saying. And this goes back to what I was saying previously in the show, that there's different quantum computing modalities. There's the fast computers, the superconducting and photonics, and then the slow ones, the trapped ions and the neutral atoms. If you have the fast flavor, so for example, you have Google working on the superconducting stuff. The estimate for the time it takes to crack a key is on the order of minutes, like roughly 10 minutes. And so what you could imagine is that Satoshi's coins would actually be stolen at the same rate at which they were mined in the early days. And Satoshi only mined for a period of 2 years or something like that. I need to check exactly. And so it would take roughly 2 years to empty Satoshi's 1 million coins. But that's with a single computer. But of course, you could just have multiple quantum computers. You could have 10 of them, in which case the timeline shrink by a factor of 10x. So this conclusion from 21 shares doesn't make sense to me.
Chris, what did you think?
Yeah, I mean, putting aside the specific numbers here, I think it's important to realize that when a technology kind of achieves liftoff, it grows very quickly, right? So the time to go from one quantum computer that can break a key in a few minutes to the time where there are 100 such computers is going to be a very short period of time. And once you're in that window, it's far too late to act, and you certainly don't want to be staring that down. So it's sort of a 0 to 1 type of situation, right, where you for a long time do not have the technology to do a task, and then all of a sudden it's there, and then very soon after it's ubiquitous.
There's also a little bit of game theory where if you do have a quantum computer, maybe your best move is not to attack addresses immediately. What you could do is kind of scale it up to 10 computers and then kind of attack those in private, and then all in one go kind of steals Satoshi's coins.
It is, yeah, we should probably mention, right, that for the situation where you have a public key that's actually public, you can run the attack in your basement, not telling anybody, and you can discover the secret key, and you can accumulate all the secret keys that you need quietly without taking any external action. And then now when you have all the secret keys, you use them to make the transactions that empty the wallets. So it's not a matter of, oh, the quantum computer has to be out there actively making itself known while it's doing these cryptographic attacks. It's a quiet attack, and then when you're ready, you take your action.
Oh, wow. This reminds me of the Bitfinex hack, where the hacker knew what all the account balances were and drained the biggest ones in order, going down to the ones that had fewer coins. So basically, the upshot is that any chains that want to prevent this type of attack have to act before quantum computing poses a threat to blockchains. Is that the basic takeaway?
That's the bottom line, and really that action to upgrade things is a long, slow one that's going to take a matter of years.
One kind of tangent, but I still think it's intellectually interesting, is that the current elliptic curves that we have use the so-called discrete log assumption. And it is possible that a non-quantum computer, a so-called classical computer, could break these things. And the reason is that there's a lot of structure in these elliptic curves, and you could imagine some sort of a mathematical breakthrough to happen. Now, traditionally, these mathematical breakthroughs have happened by humans, by mathematicians, over periods of decades. But what we're seeing with AI is that time is shrinking, and we're starting to potentially see AI as being much better than humans at mathematics. And so maybe they can find these kind of clever breakthroughs that leverage the structure of elliptic curves within a similar timeline or a shorter timeline than that of quantum computers. So this migration to post-quantum cryptography is also a migration to post-AI cryptography, and is one that in my opinion, should be done relatively quickly. And it, Chris mentioned the amazing world that would be available to us with lattices. So, for example, there's this technology called FHE, fully homomorphic encryption, that uses lattices. There's even like more fancy stuff like witness encryption and obfuscation, and these are all things that we want. But there is a possibility that lattices get broken by an AI, partly because lattices it involves these like very structured mathematical objects, and it is at least plausible that there will be a breakthrough there. And so my personal thought here is that at the very foundations of blockchains, we should be avoiding these structured assumptions. So we should be going with maximally unstructured things like hash-based cryptography. And the vast majority of assets, let's say 90% of them, should be conservatively secured. And then there's kind of the more exotic stuff that leverages the fancier assumptions that can be done on top. And if and when there is a break, it's actually not catastrophic and systemic to the whole industry.
Yeah, as my PhD advisor said, cryptographers seldom sleep well at night, because there's always this prospect that your baseline mathematical assumptions about what is and isn't secure turn out to be wrong, right? And we have to make the best bets we can with the information we have available. But as with quantum computers, the ground can shift under you quite quickly.
One final thought. Historically, the way that we've been thinking about post-quantum cryptography is as a defensive technology against quantum computers. But in recent weeks and months at the Ethereum Foundation, we've actually changed our mindset. We now think of post-quantum cryptography as being an aggressive strategy in order to attract, institutional capital, for example. And we're now hoping to be the very first global financial piece of infrastructure that is post-quantum secure, and that could potentially be used as a way to attract capital from TradFi into Ethereum.
Yeah, you've probably seen some people on Twitter making that point that Ethereum as an asset is looking very good from an investable standpoint, partly because you guys are being so proactive about the quantum threat. So yeah, I think your strategy is a good one there. All right, everyone, this has been just fabulous. Thank you so much.
It's great talking with you.
Thanks, Laura.